Significance of Individual Retirement Plan, IRA. What is InfoTaxSquared.com's goal? Our aim is to tackle every taxation topic and make it understandable to the average person. Before we go any further, the IRA is a tax deduction that lowers your current taxable income, but the Roth IRA is an after-tax deduction that lowers future taxable income. Who determines which plan is most beneficial for you? Your financial position is equivalent to your body's function. No one has greater knowledge of your body's function than you, even a doctor. Hence, a taxpayer must determine which plan is superior. What is the significance of IRA? This topic will explore the various, unique components of the IRS, which is a future savings plan. Number 1. Individuals who set aside money for retirement can benefit from the tax advantages of an IRA, a personal savings plan. Number 2. The deduction of contributions, and the tax exemption of IRA earnings until they are distributed are two advantages. Number 3. Most banks and savings institutions, mutual funds, stock brokerage firms, and insurance companies allow you to set up an IRA. Number 4. Setting up an IRA is an option for anyone who receives taxable compensation during the year. Number 5. It is possible for an individual to establish a spousal IRA for their spouse as long as they file a joint return. Number 6. Income includes wages and salaries, commissions, self-employment income, alimony and separate maintenance payments. Number 7. Property earnings and profits, such as rental income, interest income, dividend income, or pension and annuity income, or the share of S corporation income, are not included in compensation. Number 8. Individual retirement arrangements that qualify include individual retirement accounts, individual retirement annuities, employer and employee association trust accounts, SEPS, and simple savings incentive, match plans for employees. Number 9. It is necessary for an IRA account to always be fully vested. Commingling the trust's assets with other property is not allowed, except in a common trust fund, or common investment fund. Number 10. IRAs do not permit any portion of the trust funds to be utilized for life insurance contracts. Number 11. Contributions can be made every year that a taxpayer is eligible after establishing an IRA. Number 12. To make a contribution, a taxpayer must have been compensated. Number 13. After the end of the year, you can make contributions. They must be made for the previous year, and submitted no later than the tax return due date, with no extensions for that year. Number 14. It is common for contributions to be due on April 15th of the following year. Number 15. Contributions to a traditional IRA do not require age restrictions. Number 16. Contributions to an inherited IRA are only allowed to be deducted if they were inherited from a spouse. Number 17. An inherited IRA cannot receive contributions from someone who died after December 31, 1983, and was not a spouse. Number 18. An inherited IRA is part of the deceased owner's estate. Number 19. IRAs that are inherited do not receive a step-up in basis. Number 20. The taxpayer has the option to contribute the lower amount of their compensation if they file a joint return. Thus, the spouse's taxable income is reduced by their IRA deduction, which is equivalent to $7,000 into a spousal IRA. Number 21. The maximum deduction for a spousal IRA is now $8,000 thanks to a catch-up provision for individuals over the age of 50. Number 22. If a taxpayer has multiple IRAs, the limit applies to the total contributions made to those IRAs during the year. Number 23. The entire contribution can be deducted if either spouse was not covered by an employer's retirement plan for any portion of the year. Number 24. In the event that the taxpayer is not covered by an employer's plan, but their spouse is, they can still deduct the full amount of the contribution. Number 25. The IRA deduction will be reduced or absent if the taxpayer's modified AGI is covered by a retirement plan at work. Number 26. A rollover is a way to transfer cash or other assets from one retirement plan to another qualified retirement plan that is tax-free. Number 27. A rollover cannot be refunded. Number 28. No later than 60 days after receiving the lump sum distribution, a rollover must be reinvested in another retirement program. There is a rollover rule that allows for hardship exceptions. The Internal Revenue Service, IRS, has the ability to waive the 60-day period. Examples of cases include those of casualties, disasters, or other events that are beyond the individual's reasonable control. Number 29, only one rollover that the taxpayer receives funds is permitted per year. Number 30, the retirement account trustees, the managing company of the account, have the ability to accept unlimited transfers from the taxpayer. Thank you and God bless you.